Today, I'm going to share the three biggest tax mistakes every retiree makes in retirement. Because if you miss just one of these, it could cost you tens or even hundreds of thousands of dollars from your retirement savings. Now, if you're watching this, you probably spent decades saving, so you've already done the hard part. But once you retire, the game changes. Suddenly, you have options, real planning opportunities most people never see coming. So, I want to show you real examples of how to avoid these traps and how much you could save by getting it right. So let's get into the first mistake, not taking advantage of tax gain harvesting. This is a strategy that could let you withdraw significant income completely tax free. So here's how it works. If you look at this chart showing the different tax brackets for long term capital gains versus the brackets for ordinary income, you'll notice they're different. And that bottom tax bracket for long term capital gains is 0%. That means if your income stays under a certain threshold, you can realize long term capital gains and pay absolutely nothing in federal taxes. So, let me show you how this works with an example so you can take advantage of it. Let's say both you and your spouse retire. You're both 65 and file your taxes married, filing jointly. And in retirement, you both want to live on $120,000 per year. Now, most people would assume that's going to generate a significant tax bill, but it all depends on where you pull your income from. So take a look at this. Let's assume you have a substantial brokerage account with a growth stock position that you bought for $250,000 that's now worth $1 million. So that would mean of that $1 million, 75% of it is gains, and you'd be taxed on that. And the 250,000 is your principal, which is not subject to taxes. Let's also assume you have a traditional IRA and a Roth IRA. And so you're looking at your assets and you're saying, how do I create $10,000 per month and do so in the most tax efficient way? Well, here's one of the ways we can do it. Let's assume that right off the bat, you pull $30,000 from your traditional IRA. I'm going to show you why in a second, but the short answer is your standard deduction for 2025 would be $33,200, which means your standard deduction is fully offsetting that $30,000 of income that came from your traditional IRA. Now, let's assume you take the rest from your brokerage account. 75% of that is going to be gains because remember, $250,000 was invested one time into one stock and it grew to 1 million. So 75 cents of every dollar you pull out is taxable and 25 is not taxable. It's just a return of what you already put in. Now remember, our goal here, back to the taxation of long-term capital gains, it's to keep our taxable income under that 96,700 number. Because if you see right here, if our taxable income is under that amount, we don't pay any taxes on those capital gains up until that threshold. And keep in mind, your taxable income is your adjusted gross income, which is a combination of all your different incomes minus your 401k or IRA contributions minus your deduction. So, what that really means is our adjusted gross income can actually be as high as $129,000 because once we subtract out our standard deduction of $33,200, we're left with $95,800. And any capital gains below that are taxed at 0%, which is where we want to be. That means we can realize our gains and not pay any taxes on those gains. So let's go back to our example. If we sell the remaining $90,000 from the brokerage account, of that $90,000, 25% of it will just be a return of what we already invested. So that's tax-free. 75% of it, though, would be taxable. And 75% of 90,000 is $67,500. Here's a tax report to illustrate what's going on here. We have John and Susan Sample, and they want to live on $120,000 per year. They're the ones taking the $30,000 out of their IRA and the $90,000 out of their brokerage account. Now, when I tell people they can do this, their first immediate thought is, well, how much in taxes will I have to pay to take all this money out? Well, the answer is 0, and here's why. Now, I wanted to keep this very simple to illustrate the concept. So we're assuming there's no extra wages and no other income here, but we can see the $30,000 distribution from their IRA here and realizing $67,500 of long-term capital gains here, bringing them to a total income of $97,500. Now, out of this 97,500, 33,200 can be taken right off the top because of the standard deduction, removing that from taxable income, leaving them with $64,300. And we can see at the bottom here, there are no taxes at the federal level on this money. Now, quick side note, we're not looking at state taxes right now because I don't know where you live, but at the federal level, zero taxes need to be paid on this money because the standard deduction completely offsets their ordinary income of $30,000 from their IRA. And for the long term capital gain they realized, their income was well under the threshold to remain in the 0% tax bracket. So they're living on $120,000 per year or $10,000 per month, paying $0 in federal taxes. Now, you might have noticed I didn't include Social Security in that example, and I did that on purpose. The taxes on Social Security can get tricky very fast, and that leads us into mistake number two, not being aware of the Social Security tax torpedo. And just by hearing the name, this is something we definitely want to avoid. Social Security taxation works based on something called provisional income. To keep things simple, your provisional income determines how much of your Social Security benefit gets taxed. As you can see on this chart, depending on your income, either 0% up to 50% or up to 85% of your Social Security benefit can be included in your taxable income. Now, some of you might be saying, wow, these are really low numbers. And yeah, you're correct. But not all of your income is included in your provisional income. For example, only half of your Social Security benefit is included in your provisional income, or if you take any distributions from a Roth IRA, that would not be included in your provisional income. But in a nutshell, the lower your income, the more likely you are to have less of your Social Security benefit included in your taxable income. So here's why they call this the tax torpedo. As your income is rising, not only is that pushing you into a higher and higher tax bracket because of the income itself, but at the same time, it's pulling more of your Social Security income into your taxable income as well. So you actually get hit twice moving into higher tax brackets, and each dollar you earn within that certain range is also pulling in more of your Social Security benefit. Now, there's many cases where if you're in the 12% tax bracket and you earn an extra dollar, you might think, okay, that's just an extra 12 cents I'd pay in taxes. That's not actually the case. It's an extra 12 cents you pay normal ordinary income taxes, but now an extra 85% of your Social Security income is also included. So, depending on your specific situation, one extra dollar earned in the 12% marginal tax bracket might actually cost you 22.2% in taxes because that's 12% on the income plus 12% of an additional 85% of your Social Security that's now pulled into your taxable income. Here's another quick example using John and Susan's sample. Let's assume they are both retired and we're using 2025 numbers here with a standard deduction of $33,200 because of their age. Now, in this first example, they take out $6,000 from their IRA and their Social Security combined is $50,000. So they have provisional income, right? The $50,000 from Social Security benefits, only half of that is included in their provisional income. So that's $25,000. And all $6,000 of their IRA distribution is fully included in provisional income as well. So the 25,000 plus 6,000 brings their provisional income to $31,000, which means they're under the threshold of having 0% of their Social Security benefit included in their taxable income. So if we were to run a report on this, what we would see is their total income is only $6,000. Their adjusted gross income is also $6,000, as we see over here. Their total Social Security is $50,000, but 0% of it is taxable because of those provisional income thresholds. So that's all tax-free at the federal level. Pretty cool. The $6,000 is the only thing they're paying taxes on, but even still, that's fully offset by their standard deduction, keeping them in a 0% tax bracket. Now, let's look at what if instead of taking $6,000 from their IRA, they took $40,000 from their IRA. In this scenario, now they're really starting to push up through the provisional income thresholds. What you can see over here is about 47% or so of their Social Security benefit is now included in their taxable income, and that's because of their provisional income. You can also see their adjusted gross income, deductions, and total tax, but this is where the tax torpedo starts to kick in. You can see here one additional dollar of an IRA distribution would be subject to 12% taxes. And not just that, but one extra dollar of IRA distributions also pulls in another 85 cents of Social Security into their taxable income. So when you run the math, that extra dollar that you think would be taxed at 12% is actually taxed at 22.2% at the federal level. So just be aware of when these Social Security taxes can kick in so they don't negatively impact your particular tax situation. The third mistake people make in their retirement planning is underconverting or overconverting IRA balances to Roth. They either underconvert IRA balances into a Roth or they overconvert their IRA balances into a Roth IRA. And for those not familiar with this and how it works, if you retire with all of your money in pre-tax accounts, many don't realize that when your required minimum distributions kick in, you can get pushed into a higher tax bracket. The other challenge that most people aren't aware of is when those who are familiar with Roth conversion strategies overconvert today or too early. They're so concerned and fearful about what those future RMDs are going to be that they tend to convert too much of their IRAs and end up paying way more in taxes than they should have, as opposed to converting nothing. So let's look at an example to illustrate what I mean. Here we have James and Karen. They're looking to retire, and as you can see here, they've got a good amount of their money in pre-tax accounts. James has his pre-tax 401k plan. He has his traditional IRA. Karen has her traditional IRA and all these other assets. And once you start pulling them out of your portfolio, they're going to be taxable. So the challenge is understanding, when do we convert, when do we not convert, and how do we manage this in a way so we're minimizing our lifetime tax bill and our lifetime tax liability. Well, here's how we do that. We take a look at James and Karen's tax bracket today, and then we project that out over the course of their retirement. And of course, this is going to be based upon what their income sources are today and how those income sources change over time as Social Security kicks in, as pensions start to kick in, and as you're taking income from various accounts. And what we start to see is something that might look like this. Now, this blue bar represents what their total taxable income is projected to be from today all the way out until age 90. And right now, as of today, their taxable income is pretty high. They're both working, earning a decent income, and that's pushing them into a higher tax bracket until they retire. And you'll notice that this little valley right here, if they start living on cash or their brokerage accounts that have mostly already been taxed, they might be in a very low tax bracket for a long period of time. But then Social Security and pensions start to kick in. And if you look over here, when they turn around age 75, required minimum distributions kick in. So you can see, if they do nothing about this, in the future, they'll be back in that highest tax bracket again. So that's the risk of doing nothing and not converting anything. And as you can see, you'd end up paying way more in taxes than you'd otherwise need to. So what we like to show people is something more like this. What would this look like if we filled up certain tax brackets? Meaning, in those early years when your taxable income is very low, can we move money out of your IRA on purpose into your Roth IRA? But only up to certain limits, so you know and would be happy with paying 10% taxes or 12% taxes or 22% taxes or whatever the bracket might be, so that we don't pay way more in taxes in the future. What does that do? Well, here's what their taxable income was projected to look like before versus now. And you can see that levels out, resulting in $1.4 million more to the plan. And yes, they're paying more taxes up front, but in exchange for that, there's a much lower tax liability in the future. And the net benefit is that might save hundreds of thousands of dollars in tax adjusted wealth. Now, let's go back to the base case scenario, which is before converting anything and potentially leaving hundreds of thousands of dollars on the table. Here's what too many people do when they convert too much. They look at the future tax liability and say, wow, that's a lot of taxes I'm going to pay in the future. I'm just going to convert most of my account today. So let's use an extreme example to illustrate this point. Let's assume they say, I want to convert up to the top bracket to start getting everything into Roth accounts so I don't have to pay any taxes in the future. Well, if they do that and I click refresh, what you'll see is now all of a sudden the strategy leaves them with close to $1 million less in their total portfolio value because they converted too much today. So there's a fine balance between how much do you convert today and how long do you convert for. Should we do this indefinitely throughout our retirement, or do you do it for the first 10 or 12 years? But what you can see here is there's a risk to underconverting and there's also a risk to overconverting. And too often, the people who are familiar with this conversion strategy, I see them overconverting and it's costing them more money in taxes than they ultimately save over the course of their retirement. So it's impossible to understand exactly how much you should convert today and every single year of your retirement. It's going to depend on future tax brackets, investment returns, and how fast are your pre-tax investment balances actually growing. It's also going to depend on your spending and your other income sources. There's honestly so many variables that this is something that should be monitored annually to make sure you're staying on top of it and converting the right amount for you. Now that you understand how to avoid these costly tax mistakes in retirement, you might be wondering, when is the right time to actually make the leap to retire? Because sometimes working those extra years could actually be costing you more than you realize. In my next video, I break down 6 reasons why retiring sooner might be the best decision you'll ever make. Because let's be honest, time is our most precious resource, and it's the one thing money can't buy back. So click right here to watch, and I'll see you over there.